Welcome to the Three Questions Webcast series. I'm Wayne Baxter, Senior Executive Manager with One Capital Management. At One Capital Management, we develop and implement strategies for our clients that strive to grow, protect, and ultimately distribute their wealth. And we do that by offering investment wealth management services. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions Webcast series, please consider liking this video and subscribing to our YouTube channel. Now, our process for advising our cross-border clients includes an in-depth discovery and diagnostic analysis of their wealth management goals and objectives. Now, needless to say, that's going to include an in-depth review of their investment strategy. One Capital clients, whether they reside in the United States or Canada, benefit from the ongoing oversight of their portfolios. They have a dedicated portfolio manager who oversees the day-to-day trading of their investments. There's also a weekly review meetings held by One Capital's investment committee that oversees, over their portfolios. And during these meetings, there's a lot of discussion and overview of, equity markets on the global stage, U.S., European markets, Asian markets, emerging markets, and also look at the geopolitical landscape of the day. Then there's also drilling down a portfolio review that's conducted at the level of geographic allocation, market cap or size allocation. I'll look at other asset classes we could take advantage of. There's individual security selection, again, because we are a portfolio manager and we're buying individual stocks, so we look at individual security selection, obviously looking at risk management, our tax loss harvesting strategies that we can employ, and also rebalancing tactics. So very involved process for looking at our clients' portfolios. Cross-border investors looking to build a diversified portfolio between the U.S. and Canada have a broad range of conventional and unconventional investment options to choose from. On the conventional side, obviously stocks and equities. Investors can buy shares in publicly traded companies on the Toronto Stock Exchange, the New York Stock Exchange, and the NASDAQ. Bonds and fixed income investments, you can buy government or corporate bonds in both Canada and the United States. And then, of course, there are exchange traded funds or ETFs. They trade like stocks on stock exchanges, just like stocks on stock market exchanges. And there are ETFs that target specifically Canadian, U.S. markets, international markets, emerging markets. So you have a broad range of investments along those lines. And then, of course, you have, real estate investment trusts or REITs. Investors can, also choose to diversify by investing in retail mutual funds that pool money from many investors into a diversified portfolio of stocks, bonds, and other securities. So broad range of a very conventional type investment. There are also less conventional investment options, and that is where we're going to focus on our attention during this episode of the Three Questions Webcast, so stay tuned. On this webcast, we will be reviewing the 3 questions cross-border investors should ask before investing in unconventional investments. Joining me is Steve Cowley, Chief Investment Officer here at One Capital Management. He's the chairman of One Capital's investment committee. Steve is a chartered financial analyst. He's also a member of the Los Angeles Society of Financial Analysts. And Steve, once again, want to thank you for taking part and joining us here on the Three Questions Webcast.
Great to see you again, Wayne. And I enjoy these webcasts, and they remind me
now you're going to get really comfortable doing it. We're going to be having you back more and more and more. So be careful. Before we get into the unconventional investing discussion here, clients are always asking me questions about, what is it going to happen that's going to change my portfolio? So I will be remiss if I didn't ask you to share your thoughts on a question that's frequently posed by clients and or prospective clients, and that is, how will, and I'm going to fill in the blanks here, the election, the earthquake, the hurricane, the insurrection, the war, the wildfire, etc., impact our investment strategy? Now, to be fair, I've lumped in a bunch of things together, including a couple, for those who are paying attention, a couple California-related events here, but you get the idea. Like, how do those sort of things affect, the investment committee's perspective on how to invest going forward?
Wayne, this kind of reminds me of our 5-minute chats that we have.
They last about 45 minutes, yes.
Exactly. So, what's interesting about those things, and you mentioned California earthquake and wildfires. Well, wildfires are no longer a California thing. Half of Canada.
Well, fair. Yeah, my home province of Nova Scotia has had to deal with that here just recently, by the way,
Exactly. And
in a big way.
And New York City had to deal with what we deal with on usually an annual basis out here in California with all of the smoke and the fires. But what's interesting about all of those items and how is most of those things are short-term shock type of events. If an earthquake hits, it's devastating. It affects the people around the earthquake. It affects things that are happening. I was fortunately not here during the Northridge earthquake down here in Los Angeles. We moved shortly thereafter, and was able to buy my home at a discount because I bought it off of somebody who had suffered some damage in the earthquake. But they can be devastating for the people, and they can last a long time for those people affected by it. But from an economic standpoint and from a portfolio management standpoint, a lot of times those disruptions are short-lived and they become opportunistic. So of course, I'll stick with the earthquake analogy since I brought it up. You have to rebuild. You've got to rebuild the houses. So, all of a sudden lumber sales go up, cement sales go up, steel sales go up. More people are working because you got to get that stuff back to work sooner rather than later. So when all of these things happen, we have to, the individual needs to step back and say, okay, is this something, and we do this on the investment committee side, is this something that has changed the outlook long-term, or is this just a short-term event that then has ramifications, and what are those ramifications and where do you go from there? So usually we look at these things, of course, we have the empathy and all of that goes out for those affected by it. But from an investment standpoint, a lot of times those are opportunities to look for what's going to happen afterwards. And part of our job is always, it's not just looking at today, it's not even just looking at tomorrow, but it's also, and it's not looking at what happens because, what happens to X if Y happen. We have to think broader than that because it's the unintended consequences. It's the unforeseen things that really are where the opportunities present themselves. So in the investment committee meeting, and when we talk about this, when we look at from an investment standpoint, we're trying to look at not just, what happens tomorrow, but we want to know what's happening next week, next month, next year. How broad does it go? How many people are affected by it? And so usually they're scary. They, markets react to it short term, but it usually presents an opportunity for people who are paying attention and looking at it on the big scale and not just the small scale.
Okay, so that makes sense for the hurricanes, earthquakes, wildfires. Does it also apply for, say, a federal election or
yes,
midterm elections? Would you say it's equally applicable?
Yes, I'm chuckling because it has a little longer ramification. But one of the things that, especially here in North America, both in Canada and the U.S., whether you like the prime minister or the president, whether you dislike the prime minister or the president, whether you like the party that's in power, whether you dislike the party that's in power, whether you're like all of those things, it's the beauty of democracy is that's what elections are for, and things change. And because we have, multi-tiers in our governments, nothing gets, it's not a dictatorship. It's not going to, there's not an edict that's passed. It has to go through the process of legislation. There's lots of fights and there's brawls, and they go up to the media and they scare us all because they say, Wayne is a bad guy because Wayne doesn't like this, he's a bad guy because he doesn't like this. So there's lots of fear mongering that goes along those lines. But the reality is the process actually works. That no one party won.
I don't like the idea of Wayne being called a bad guy, though.
I'll switch it. I'll say Wayne's the good guy in this scenario.
It's too late. The toothpaste is already out of the toothpaste container, Steve.
Well, I called myself a bad guy too. So
yeah. No, well, too funny. That's really good. So one of the ways I describe it, I think you and I think I've shared this one with you before about the difference between investing in politics, and that is when a new regime comes into power, you pretty well know what to expect over the next 18 months. But understanding or trying to project how that's going to affect things 5-10 years down the road is virtually impossible. You have no real idea. And on the other hand, if you look at investing, if you come to me with $1 million today and say, okay, put this money to work, Wayne, and oh, by the way, what do you think we're going to see in the next 18 months? The best I'm going to be able to do is probably shrug my shoulders. I really won't know. But if we stick to our globally diversified portfolio, apply systematic rebalancing, our systematic asset allocation, stick to our knitting. 10 years from now, I got a pretty good idea where we're going to end up. Pretty good, not perfect, but pretty good idea. So that's kind of the difference between, politics is pretty short term, investing is pretty long term. Politics is pretty predictable over the short term. Long-term investing, surprise, surprise, is pretty predictable over the long term. And again, I think it's really important to remember that, generally speaking, markets are cyclical, and typically speaking, again, short-term events are usually followed by a recovery. I think one of the most common mistakes I see from less experienced investors is that they sell investments in a panic during a market downturn.
I learned that lesson.
Go ahead.
I was going to say, I learned that lesson years and years and years ago when I was relatively new in the industry, not from anything and a mistake or anything I made from investing, but I had a good friend who was running a company, and they'd just gone public, and they were doing really well. And it was all the way back in 1986 when they changed the tax laws down here in the United States, and it was going to be pretty burdensome on some of these companies. And so talking to him. I was actually coaching soccer, and I talked to him when our kids were out there playing soccer. And I said, Dave, what are you going to do about the tax law change? Which would really affect your company. And so I was thinking exactly like you're talking about, what's going to happen? Oh, it's going to be terrible. He said, Steve, don't worry about it. We'll figure it out. We'll move on, and we'll still make money. And it was such a great answer, because it's like, oh, that's exactly how we all react to all of these things that you're talking about here. Earthquake, fire, you adjust, you make changes, you rebuild, you move, you do whatever you need to do, and you move forward and you live your life. And so I learned early on that that's important, that you got to look past that we're all going to adjust to whatever happens and then make the best of it that we can.
Yeah, I think we would both agree that long-term investors understand that the importance of staying the course and not reacting to short-term events, like not panicking. They have to keep their eyes on from being impulsive. I think of my favorite three letters when it comes to investing. The ISM, the incredibly short memory, and really allowing also, letting their emotions get to the best of them. All right, great job. Let's get to our quick three questions today. And again, what we're focusing on today are the three questions cross-border investors should ask before investing in unconventional investments. So the first thing, and again, when you think of unconventional investments, we're probably not going to include all of them, but I think for the sake of this discussion, we would probably include in today's day and age, gold, crypto would be an example, NFTs be an example. It's a subjective thing. Some people may say venture capital could be considered unconventional.
Collectibles.
Yeah, exactly. Collectibles, art. So there's a whole broad range. We could add on to the list, but let's first of all talk about what are the advantages and disadvantages of investing in these areas.
Well, the biggest advantage is, one of the things that you talked about early in the promotion side of things is non-correlated assets. They don't move at the same time that publicly traded assets do. If the stock market is doing poorly, well, because a lot of these, unconventional, if you will, are not the classic investments, they may be mostly immune to some of the market downturns. again, when the market goes bad and when we have a downturn, the very rich a lot of times don't really suffer much because they may not have, instead of taking 5 trips on their private plane, they take 4 trips on their private plane.
Mhm.
So it's kind of the same thing. These things don't move in the same pattern because they're a different thing. So the advantage is that you have the ability to have an asset that is completely uncorrelated to the public markets, to the fixed income market, to the equity market, to the real estate market in a lot of time. And so that's the advantage of them. The disadvantage, of course, is how do you buy them? Who buys them? Where do you buy them? Some of these that you mentioned can be, they're notorious for irreputable dealers. One of the things I remember, again, going back to my youth, one of the guys I worked with, I was working construction at the time. He, back in the 70s, and he bought gold and silver, and he was buying these gold and silver, and they opened the vault because people wanted their money back, and there was no gold and no silver in the vault.
Oopsie.
Yeah. So sometimes with these unconventional, you can get, you have to be more careful with who's providing the information. A public market, if I'm buying Microsoft stock, it's you're pretty sure you're going to get what you're paying for it. Obviously, you don't want to go with the shysters and all of, but any reputable firm, any reputable custodian, you're going to know and you're going to have what you're looking for. So that's some of the disadvantages that you have with those. And then finding and value. We're going to talk about the risk as well.
Yeah, that was actually my second question. We probably could hop right into that.
Yeah. So
advantage. Okay.
Go ahead.
I was just going to say, so I think when I think of advantages, I think of the opportunity. That's when I think of unconventional investments, Steve. I think the thing that comes to my mind is usually there's an outsized opportunity that really attracts the investors that I don't want to say get rich quick, but there's an outsized opportunity to make a significant profit over potentially a shorter period of time.
Exactly. And we've all seen it. We've all been approached with something that we didn't take advantage of when maybe we should have. Back when I was in college, I should have bought a condo in Park City, Utah for $100,000. I mean, the bank
that'd be worth about 1.6 million right now, I can tell you.
No, it would have been worth about 3 million the one I was looking at. So
oh, really nice. I was working with a client that we just went through that exercise. So yeah, it's different price points today.
Exactly. And so we all know about the opportunity that could come from some of these unconventional because, it's like, oh, I wish I had done this. Oh, I wish I had done that. And the early investors in some of these things, especially like crypto and NFT and some of the collectibles and art and stuff. I mean, you always see the headlines of, Van Gogh's sells for a new record of $37 million for a piece of art that somebody bought 20 years ago for, 100,000. So you're right. The advantage is that opportunity, that ability to say, hey, this is different and it's going to react different.
All right.
So the risk and disadvantage.
Let's get to the second question.
Yeah.
Let me set this up for you. A really hard question. Number 2. So first question was, what are some of the advantages and disadvantages of unconventional investments? Number 2 is, what are the risks? And I think we got about 4 in particular that come to mind here. So I'd like you to go through each and every one of them if you could.
Yeah. So the risk is also the kind of lumps in a little bit with the disadvantage of them. So the first thing that comes into play is liquidity. Again, there's a hot market for them. And I'm going to pick a little bit on NFTs for a little bit because an NFT is a non-fungible token. Again, I could say that 10 times and most people won't understand what that means.
They're going to be going on ChatGPT and trying to figure out what that is, right?
Exactly. So non-fungible token is basically an electronic image or thing that somebody can verify that it's the original. And so there was a real hot market about a year and a half ago in NFTs because Jack Dorsey sold the very first tweet because he owned the first tweet. And he sold it for lots and lots of money. Well, the problem with it is that was a really hot market, and then it dried up. And so people that were paying $40,000, $50,000, $10,000, $800 for different NFTs, that market's dried up and there's no liquidity. So you can't sell it. Like, where do I now turn over my money and get it back? And that happens with the unconventional. A lot of times that's the biggest risk, is probably liquidity. How do I get my money back? I made a great investment. And so you kind of have to wait for opportunities to sell. Now, certain things, certain art pieces will sell at any time. I mean, if you've got a Van Gogh, it's going to sell anytime. It may have different valuation, but it's going to sell at any time.
Yeah, if I have an original Monet, I'm sure I'm going to be able to find a market for it somewhere.
Exactly. But liquidity is probably the biggest with most unconventional. Is you kind of have to get it when people are excited about it and hold it when people aren't. And it goes back to this youth way back when the friend of mine that had the gold, another one that I worked with at the same time, he bought a bunch of Krugerrands from South Africa, gold Krugerrands, which was great. But we all know what happened early 1980s when apartheid came in, and they shut off the market. So this guy literally had, a lot of gold Krugerrands that he had no market for, because in the U.S. you couldn't trade them, you couldn't sell them, you couldn't buy them. It was actually illegal. So now it actually worked out for him, because when they finally took that ban off of it, gold had run quite a ways, and he probably would have sold it and made no money at all. But he had to wait that 30 years, and when he was given the green light to sell them, they were actually back in value.
That's a super long-term investment there, Steve.
It was way too long-term. It was way too long-term for him as well. So liquidity is the biggest issue. And then I talked about valuations. That's the other issue that you run into, the kind of the next risk, if you will. What's an unconventional worth? Because if I've got a share, I've got one share of Microsoft, I can look at the New York Stock Exchange, I can look at the different stock exchanges, and I can quickly value what that one share of Microsoft is worth. Mm-hmm. If I have an NFT, like I mentioned, it's only worth what somebody's going to pay for. So it's really hard to value that. If I've got gold, again, gold's a little bit easier, but the liquidity comes into play. Where do I sell it? Is it, who's going to mark it down? Those things. So the valuation can be a real problem, or risk. I shouldn't say problem. It's a risk with the unconventional type of assets, because it's only as valuable as somebody wants to put on it. When it's in vogue, everybody loves it. When it's out of vogue, nobody thinks about it. So it's hard to get a good valuation of it.
There's also, I just thinking about when you're talking about valuation, the next thing that comes to my mind that goes kind of in my investment thinking is earnings. Like, we think of a stock, usually there's earnings that were, earnings per share or yield. Like a lot of these investments, not all, but a lot of these don't necessarily have that component to them. I guess NFT would be a good example. They don't typically kick out a dividend, right?
Gold's a great example of that as well. If I own a lump of gold here, it doesn't do anything except for sit on my desk and it's a nice paperweight. But it has a store of value. I'm not saying it's a bad thing. It's just there's no dividends kicking off of it. Like my friend who had to hold it for 30 years, he was basically sunk money for 30 years until he actually could find liquidity for it. Mm-hmm. So valuations can be a problem. And actually, the same thing happens in ultra high-end real estate. Somebody sells a home here in Los Angeles and they sell it for $50 million. Well, it's just because there's people flush with cash. It's the thing they're doing. Well, you want to sell that tomorrow. You might not have a buyer. We might be in a recession. There might be some reason, and all of a sudden that $50 million property has to get marked down to $30 million. So somebody will buy it, or $20 million. And I've had experience with that. A kid that I knew worked on spec homes over in Beverly Hills, and they built this spec home, and it was beautiful. It was absolutely spectacular, and they were asking $23 million for it. There was a little bit of fraud that was involved, and so it ended up getting repossessed with the bank. They ended up selling that quote $23 million property for about $8 million.
So that goes back to what you mentioned earlier about it's worth what people will pay you for.
Exactly. So that's the risk with valuation with an unconventional, because there's not a ready marketplace for a lot of these things. One of the things that you mentioned was like some alternative investment, private equity or something like that. A lot of times those have a 10 or 15 year lockup period. So you've got time that you've got to, there's no market for the secondary on things like that.
How is storage, like, where's the risk there, like, in your view?
So there's, that's the third risk that we talked about is storage is where do you put it? So I mentioned the gold earlier, that supposedly stored in the vault and it wasn't there. So if you take gold and early in my career, I actually, company I worked for, we used to sell gold and silver coins, and the Canadian gold coin was it was the coin that we wanted. Because I hate to say it, but the U.S. coin at the time wasn't as pretty as the Canadian coin. The Canadian was 24 karat, the U.S. was 22 karat. Like you said, so we sold a ton of Canadian gold coins, and it was, it's where do you store it? Like, if you really have a significant part, where do you put that? The safety deposit box, which is going to cost you them. You put it in your house. You have a vault in your house. So storage becomes a problem. How do you store crypto? Well, crypto, you do it through an electronic vault that they have. But one of the things that a lot of people don't recognize is that when crypto is in transit from one vault to the next vault, it's just a short period of time. It's actually vulnerable to theft. And there's been multiple thefts where when somebody was transferring one crypto to another, in the middle, somebody was able to pull it out, and it's so hard to identify whose crypto that is, or whose it is.
Whose coins they are.
Exactly. So, and then what do you do with art? Again, if you have your Monet that you said is, it's at your house, you can't just hang it on the wall.
I got to confess, it's a print. Okay.
Okay. You can't just let the sun ruin it. So you have to store it the proper way. You have to have the right glass on it. You have to, and actually I had a client years and years ago down in New Orleans, and they had a home. I mean, a home was a piece of art, and it was an old historic home, but they had art over the whole home. Oh, to do that, they had to literally wire every single piece of art to their alarm system. They spent a fortune making that home into basically Fort Knox, because there's probably $100 million in art in that home.
My word.
So you can't just expose that. So storage becomes a problem. Where do you put it? How do you store it? Collectibles. Again, it's not. Sometimes they're fairly small. So if you got a Honus Wagner baseball card, it doesn't take a lot, but it's so valuable. You don't want it in your house, because what if your house catches on fire? You got to put it someplace where it's not going to burn up and all the things. So storage can be a risk to some of these things. I worked for a company years ago, and they would store art. Like, hey, the cost to store art was actually really expensive. The annual fee was way more. I remember thinking, I'd put it on my house and wire my house before I pay that fee to store.
Okay. Maybe a little bit before we go to question number 3 on security and speculation. How do you see, where's the risk here? Like, what's the concern?
On security
and on speculation, like what's the speculation risk? Is there anything there? Like, I think about speculation as basically just the risk of again, I think it goes back to what you talked about earlier is valuation. Like, I'm always thinking about speculators. They always get themselves in trouble.
I think actually speculation is a significant risk, and it actually does warrant a separate thing, because again, you mentioned people want to get rich quick. There's like, oh, here's the new thing. Well, the problem with speculators is they're doing just that. They're guessing at what it's going to be, and they can run prices up without any knowledge, without any basis, without any understanding of that. And so, investors might say, hey, I want to get into this unconventional because look, it's running, the price is going up, I need to be involved with this. Well, a big part of that may just be speculators. And when they go away because the next shiny little toy that's dangling over here, they're going to go over and chase for their speculation, then you're left behind holding the bag. And then the true valuations come into play. And you're like, oh, whoops, maybe it wasn't what I thought it was. So the speculators can really run things. They can change prices. And that actually happens in the public markets as well. You can have some runs that happen because people, again, a great example was that, the Reddit stocks, GameStop, somebody on Reddit text that GameStop
The meme stocks.
about to go, yeah, it's about to go bankrupt, and somebody on Reddit says, "Hey, let's buy this stock," and it runs. Well, those are speculators, and the real value of that was. I mean, I remember thinking, and I think you and I even had a discussion about it, Wayne. I was scratching my head saying, "Wait a minute, have you ever been in a GameStop? It's really it's a poorly run store. There's a reason that they were struggling."
Well, actually, I have because at the time I had, well, he's no longer a teenager, but there was a period of time where my gamer son would be well ensconced at the local GameStop at the Oaks Mall in Thousand Oaks, California. Pretty popular spot.
Yeah, that's why I say I do think it is a risk to speculators, because those tend to be moved because there's not as much liquidity, there's not as much availability of those. So speculators can move those quicker, some of the unconventional, than they could. Part of the reason why GameStop was a winner for speculators, because it wanted to make people like, you couldn't have done that to a company like Amazon or Microsoft. There's just too many buyers and sellers with them. So speculators can move these unconventional because there's not as many of them available.
Well, I can tell you the Baxter household is doing its part in helping keeping Amazon stock at the current valuation. I can tell you that much. Okay, number 3. We've covered, a lot here with unconventional investing. Now, I think that I will say this right off the bat, and if you don't bring it up, I'm going to, one capital has to some degree tippy-toed into the unconventional investment water here over the last little while. So I'm going to put it to you right now, Steve Cowley, Chief Investment Officer, One Capital Management. How does One Capital approach investing in unconventional investments?
So one of my favorite sayings, and you've heard me say this many times, Wayne, is we like to invest in things that work, and they always work. So part of why we've tippy-toed into some of the unconventional, and some of the unconventional for us would be, we have private equity in an alternative vehicle type of thing. Some clients have some gold and silver, which again, you might argue that it's mainstream because it's been around for so long. But I would still call it as an unconventional. Like I said, we like to see things that work and that they pretty much always work, that we can understand them. And that's kind of when we go into it. Because again, the advantage of having an uncorrelated asset is very valuable in a portfolio. In the alternative space where we kind of tiptoed into some of the private equity debt and things like that, we're getting good yields. We have a pretty good understanding of what's going on.
Private credit, right?
Exactly. And we're looking at some of the private equity stuff that we could tippy-toe into in the next little while as well. So
it would definitely qualify as unconventional under the categories that we put it, because I think about the private credit strategy that we employed for a lot of our clients. There was a liquidity issue, or I guess we call it liquidity constraints.
Yeah, and there is still a liquidity constraint with that.
Right. That's why we kept our exposure to a small portion of our clients' bond portfolios. But I think that would definitely be under the category of unconventional.
Yeah. And so like I say, the opportunities are there.
I don't know if my friend Randall Curtis is going to agree with me on that one, but I would say that Randall's our Deputy Chief Investment Officer and the head of our fixed income team. We'll see if he agrees with me when I refer to that strategy as unconventional.
Yeah. So again, the opportunities are there, the advantages are there. So we'll kind of go into that. But for us, liquidity is a big factor. And so, we don't want to have people go into something and just not be able to get their money back.
Well, for the portfolio management team, or for the PM that's overseeing our individual client accounts, it would be a pretty significant set of handcuffs that would be thrown on them if we had, say 50% of the bond portfolio in something that only trades on a quarterly basis. That would be a little bit of an issue.
Yeah. How do you rebalance the portfolio?
How do you rebalance a portfolio? Like, markets don't necessarily conveniently correct on a quarterly basis, right? I mean, I'll bring you back to say March 2020 as a refresher on that one.
Right. And so the way we approach it is, like I say, we'll take advantage of the things that make sense for clients. Again, there's not a lot of those. And then most of it we'll stay away from. It's, again, I'm I'm not disparaging those things, but collectible is not something we're going to put in the portfolio. That's going to be more of an individual item that somebody does on their own. If you want to do it, talk to Wayne. It's not going to be part of the portfolio.
Yeah, which actually perfect segue into a call to action on planning. So your clients come to me and oftentimes, when this is where the cash flow planning and capital forecasting can really help, because clients are sometimes in a position where they can take a sleeve of their liquid assets and put it towards, we'll call it again, unconventional investments. And, it could be something that they're passionate about, that they really want to believe in. And I don't think it's our business to discourage that. The thing that I would say is this going to interfere with your ability to achieve your stated objectives if they were to not achieve, or, if they were to not make the return, or maybe they don't actually make any money, they could actually become a zero-sum loss over a long period of time. If there's no risk to that at all, I think people should be encouraged, if they want to, put a few $1,000s, depending on their liquidity, into these alternative investments, knowing full well that, hey, if it works, great, perfect for me. But if they don't work, we're going to be okay. Which is, I think most people, that's their number one objective, is making sure that they are okay. And everybody, of course, has their own version of okay. So the capital forecasting and the analysis first, and then once you get that done, that's when you determine how your money ought to be allocated. And really, once you've done that, the key is really to stick to it. I think that's where a lot of people get messed up, is that they're affected by the short-term events and end up, chasing returns. And I think for most investors, that's something we want to avoid at all costs. My experience goes back, maybe not quite as long as yours, Steve, it goes back quite a while. And my experience is chasing returns. Well, my first boss said it best. He said, Wayne, market timing equals death. Can't get much more succinct than that, I think. Steve, any final thoughts here? Maybe lighten the mood here off of that last comment, but any final thoughts before we wrap up?
No, I was going to say, actually, I think you really hit it. I think you hit the most important parts there with the,
not to talk about death, hopefully, but
exactly understanding your needs, where you're going, what's happening with that. I think that the thing that I would, my final thought would be, make sure you understand what you're getting into, because there's, so many times in the unconventional, you get snippets of what it is, you get ideas, you get, a media report, you get a news article, your friend tells you about something, but you really need to understand what it truly is. And if you do, and you make a decision, then we're okay with it. But where we really struggle, and this is why it's really important to talk to, to your advisor, talk to Wayne about these things, is because you need to understand what the unconventional investment is. So if you understand it, if you truly understand it, and you want to do it, I agree with you wholeheartedly, Wayne. But what we find so many times is people will come to us, they'll ask us about it. We'll basically educate them on what they're really looking at, and usually they say, "Oh, I didn't know that. I don't think I really want to do that." So understand the investment before you make any decisions. I think that's really important.
Okay. On that note, Steve, I want to thank you for making time, your busy schedule, to join us here on the 3 Questions webcast series. Steve Cowley is the Chief Investment Officer, Chair of One Capital Investment Advisory Committee, and can't thank you enough. I look forward to coming up with another great topic, and we'll have you back on soon. Steve Cowley, thanks a lot.
All right. Well, thank you, Wayne. And I look forward to our 5-minute conversations.
Yeah, our next 5-minute conversation. Yeah.
We'll take one of those and make another 3 questions out of it.
For sure. We'll solve the problems of the world.
Yeah.
That's Steve Cowley, folks. Thanks a lot, Steve. I look forward to bringing you the 3 Questions webcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our YouTube channel. And to receive a notification of when our latest webcast has been posted, please click on the notifications bell. Lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below. You'll see it right there, www./meetwithwayne. Thank you, and we'll see you soon.